Hey guys, welcome back on the channel. In this video, I'm going to show you how to use Uniswap's liquidity pools, how to deposit into them to start earning passive income. This is a follow-up of my last couple of videos to give you a step-by-step approach to this, introducing you to the whole concept of DEXs, how they work, how you can earn with them. And each step goes a little bit deeper. It's not rocket science, guys, like I keep telling you in other videos. That being said, let's get started. I'm gonna go ahead, click the Explore tab and just click Pools. This is a look at Uniswap's analytics. This will give us all the information that happens on this exchange. Uniswap is one of the biggest, actually it's the biggest exchange, even in TVL and many other metrics. It's definitely a top exchange you want to start using, especially if you're completely new to crypto and being a liquidity provider, because this is a reputable protocol, and unlike centralized exchanges, everything that happens here is recorded on chain. You don't believe me? Check out this. So you got tokens, pools, and transactions. We are already in the pools tab, so this shows us all of the available pools in Uniswap's DEX in plenty of blockchains. You see there's a small icon here in front of some token pairs. This is where the liquidity pool is deployed on. So this is on the Unitrain, this is on Base, this is on Arbitrum. You get the idea, right? Uniswap is present in all of these blockchains, 30 something, 38 or 40 something blockchains. You don't need to provide liquidity in all of them, of course. Stick to the big ones, stick to Ethereum, Base, Arbitrum. Solana, they're not having liquidity pools deployed there just yet, so I'm not going to talk about that. If you want to go on Solana, use Orca or PancakeSwap, like I mentioned in my previous videos. You can also go on Polygon and on BNB chain, but BNB will be better if you use PancakeSwap. You'll get much better performing liquidity pools. So these are just a couple of the tips that I want to share with you in this video in case you're completely new, okay? So if you're starting and you want to start with Uniswap, which is a good choice, go with Ethereum, Base, Arbitrum, and you already have 3 blockchains there that are high volume, so that means the pools will perform very, very well. And if you want to be even more successful, I will trim it down to 2, Base or Arbitrum, not because Ethereum has anything bad going on with it. Of course not, that's not the case. Ethereum is a great blockchain to provide liquidity, they have a ton of volume, but the gas fees here are going to be much higher than compared with Base or Arbitrum. In these couple ones, you'll pay cents for gas fees, so whatever transaction you do, deposit, withdraw, compound into the liquidity pool, harvest rewards from the liquidity pool, you will always going to pay gas fees. On Base and Arbitrum, you're going to pay fractions of cents, all right? Ethereum, like I said, it's a great option, but as a complete beginner, you likely will do some mistakes, so probably not the best choice for your first go. That being said, let me just show you another thing. If you go here under transactions, this is more as a side note, just to prove the point that decentralized exchanges operate on chain and every transaction is shown here, unlike centralized exchanges. So that's a big difference, guys. Everything is recorded on chain, and that's how transparent they are, and everything can be traced back to on-chain records. So let's go back here onto pools. Let me just give you a breakdown of the whole dashboard. First, we have the pool liquidity pair, both tokens in the pool. Whenever you want to buy a token, you have to use some other token to pay. That makes a liquidity pool pair. If you want to buy Ethereum with USDT, you use this pool. If you want to buy wrapped Bitcoin with Ethereum, you can use this pool. So you get the idea, right? Whenever you're swapping tokens on chain, liquidity pools are going to be used that will generate fees. And that leads me to the other point here, fee tier. This is how much traders pay for swapping tokens. Whenever you swap, let's say $100, you will pay 0.3% of those $100 in fees. Those fees are going to pay out to liquidity providers, and liquidity providers will earn their share of the pie depending on how much liquidity they did deploy into the liquidity pool. So for example, this pool has, let's say they have $1 million worth of liquidity, and let's say you're the one person that created the pool, you deployed $1 million worth of liquidity, you will earn 100% of the fees generated until someone else comes along and deposits more into the pool. If that's going to be the case, then you guys will split the share of the pool, okay? So another example, if this pool is $1 million, but you only deposited $100,000, you'll get 10% of the fees. This goes to show, guys, it's not magic internet money. Liquidity pools are coming from real utility, on-chain utility demand for trading tokens, and that's how people make money with liquidity pools. Picking up on that, you will understand that the higher the fee tier, the better for you as a liquidity provider, because the more you will earn. But of course, as a trader, you want to pay the less amount in fee tier because that's going to be a cost for you. So traders will tend to use these lower fee tier pools. Now there's so much on-chain activity that regardless of the fee tier, it can be even 1%, you will still get some rewards. But depending on how the markets are behaving, how much volume of trading is there ongoing in the market, some pools will be more used than others. In my experience, 0.05% fee tier pools will work very well in hot markets, in colder markets, bear markets, bull markets. So you can start with these ones. And of course, you can set up your liquidity in different liquidity pools with different fee tiers. And after a couple of weeks or a month, you will see which one performed the best. Okay, so that being said, let's move on to the protocol. In my previous video, I explained it, but I'm going to give you again the rundown. V2 is the original liquidity pools. These are much more simpler. You come here, you deploy liquidity. You don't have to set ranges. You just add liquidity, both tokens in the pair. Continue, you select an amount, you deposit, that's it. While if you're using something else, like a V3 or a V4, I'll tell you the difference. So V3 is a concentrated liquidity pool, and you have to select ranges. When you add liquidity to this pool or any V3 pool, you will see here that number one, you can select the fee tier once again, 0.3, 0.05, 0.01, and 1%. 0.01 tends to work really well when there's high demand from the markets. It's not rare to see this one outperform the others. Although the fee tier is lower, it will earn you more fees here because there's so much volume and the volume is being directed to this pool. In hot markets, I see that happening all the times. But you choose your pool fee tier, the one that you like the most, you click continue, and then you will have to set up ranges. There's already predefined ranges. So stables here are very narrow ranges. It's good for stablecoins because stablecoins are meant to have their value just at around the dollar value. They will be slightly above or slightly below a dollar. So usually that's why you see very narrow ranges with these stablecoin liquidity pools, because otherwise they wouldn't be as profitable if you have a very wide range. And you don't really need that wide range because the stable coins are designed to have their value according to the dollar. They will need something crazy to happen in order for them to depeg, okay? Then wide pools are good for volatile pairs. In doubt, just go with wide. This big pink block is your range, okay? So as long as the price, which is the pink line, is in between your range, you generate fees. And then you have here the time metrics. Pay attention that here it starts at around December the 20 something and it goes up until today, which is January the 22nd. But if I go with all time, it shows me the metrics for since when the pool has been created. And this gives you an idea of how the price evolved and how a potential range would allow you to capture fees during all time or not. Because sometimes if you go with something like this and you make it a bit more narrow, and this is a bit more narrow range, you see the white lines is whenever the price went out of your range, your liquidity is still there, but it goes into dormant mode. It will not generate fees. So here back in January 2022, it was generating fees, then the price went down. And if you didn't touch your liquidity, you had spent the next couple of years until January 2024 without earning any fees from this liquidity. The good thing about it is that you would not lose anything due to impermanent loss. You would not have withdraw your liquidity. You would not have locked any impermanent loss because of that. And when the price goes back into range, everything is automated. You don't have to do a thing. It's completely passive. As long as the price goes back into range, it starts earning you fees once again. Once you are happy with your chosen range, and by the way, we're talking about the custom range where you have full control over how much you wanted to be above or below the current price. This is the custom ranges that you will have to determine yourself. You can always go full range, which works very much like the V2 version. In this case, it doesn't really matter what the price of the token is. As long as it is being traded, it will generate fees. It doesn't matter if Ethereum is at $100 or 10,000 or 100,000, okay? The downside of full range is that your earnings will be much more diluted. You will have much higher gains if you set up a custom range, because this is a more capital efficient way to provide liquidity, although there's pros and cons to both. So be aware of that, okay? Once you are happy with your range, you can go down, insert how much tokens you want to add, connect your wallet, deploy liquidity, and that's a done deal. At the end of the video, I'll show you exactly how to do this step by step. But here on the left side, you have everything mapped out. Step 1, select token pair and fees. Step 2, set price range and deposit amounts. And this is how V3 liquidity pools work. So let me go back here to find a V4 pool. V4 is exactly the same thing as V3. The difference is that the fee tier here will be dynamic. So over time, depending on how much this pool is used, you will earn more or less in fees. The fee tier will automatically adjust. For example, right now we have a $42 million TVL and the past day volume was $20 million. If the volume is higher than this and it goes above the TVL, which is great, as a liquidity provider that will print, you will see that the fee tier will increase. At the same time, if the volume keeps going down, you will see that the fee tier will also drop. And essentially that is the difference between V4 and V3. Which one should you choose? Well, you will see that V4 sometimes they will have incentives because they want people to start using V4 liquidity pools. You can go with both for the same token pair with the exact same range and see after a couple weeks, a month, which one is performing better, and then withdraw liquidity from the one which is underperforming and deposit into the other pool. As simple as that. Remember, there are no locks. You can deploy liquidity, withdraw liquidity whenever you want, and the same goes for harvesting your liquidity pool fees. You can claim whenever you want. Now let's talk a little bit about TVL. TVL is how much money people deposited into the pool. The bigger the TVL, the better, because it can handle larger amounts of trades and also larger volume trades. At the end of the day, it will be able to do more business and earn you more fees. So don't think that just because the TVL is $100 million, if you come and deposit a couple $100, it will not be worth it. It will be worth it as long as the pool has high demand. And what determines the demand is the pool APR, which will be calculated according to volume. So this is the key metric of any liquidity pool. Volume to TVL ratio. When you see a pool that has a volume which is equal or above, especially above the TVL, that pool is printing. So take a look at this example. $111 million TVL, $55 million volume in the last day. Although this is not optimal, the pool APR is already very close to 55%. Don't get too caught up in this because this will change. If the volume goes up tomorrow and the TVL goes down, for example, the pool APR will just go straight up. And of course, the opposite can happen. If the TVL, let's say if it remains the same, or if it goes up and the volume goes down, the APR will start to decrease. So let me sort this out by 30 days volume, because that's just me. I like to be a liquidity provider in the long run, because if not, I'm essentially trading. And I don't want to trade. I don't want to look at a screen 24/7. So I like to go with wider ranges to be a liquidity provider for a longer period of time. So take a look at this. In the past month, this liquidity pair on Arbitrum, Ethereum paired with USDC, that has a TVL of $78 million. It generated 3.4 billion with the B dollars volume in the past month. And even just yesterday, this generated a volume of $213 million. So this pool is printing. Pool APR very close to 50%. And by the way, compare it with these other stablecoin liquidity pools below here. These have a much lower fee tier. That's why, although they do have a very high volume to TVL ratio, the pool APR will be much lower. Although for stablecoin pairs, this is great stuff that we're looking at. Another very good comparison we can do is compare the first pool here with the fourth. It's still Ethereum paired with the stablecoin, a different stablecoin, but still a stablecoin. It's the same V3 concentrated liquidity pools. The fee tier is different, And so, although the volume to TVL ratio here, it's still roughly 10x, which is really good, but that pool APR reflects just that, how much lower the fee tier here is. So it's 34% pool APR versus 50%. This pool could outperform the first, yes, but they would need to have more volume flowing through it, because they have a lower fee tier, okay? So let me wrap up once again mentioning this last column here, volume to TVL ratio. This is what I just told you about. The higher this number is, the better. Volume is how much business is flowing through a given liquidity pool. The TVL, it just shows how much money people deposited into it, and the fee tier will determine how much does it cost for traders to do business with liquidity providers here. So the volume to TVL ratio can also change over time, but look at high volume to TVL ratio numbers in order to determine which pool is more profitable. So once again, comparing the first and fourth liquidity pools, although the first one has a lower volume to TVL ratio, you see 2.7, this one has 9.2, the kicker is the fee tier. But generally speaking, volume to TVL ratio will just determine the APR, and ultimately the APR is what shows you if the pool is performing really good or not. Then you will also have reward APR. These are incentives. Usually they will be paid in Uni tokens here on Uniswap. Uniswap, it's not famous for its incentives, although they can have some incentives here and there, but they're not going to be anything crazy in my experience. But if you find something like this, and let's say you want to provide liquidity with stablecoins, which is a very safe way to earn money, you will not be exposed to impermanent loss, although in theory you can if they depeg. But in any case, whenever you see these pools being incentivized, go for it. You will earn not only pool fees, but also incentives paid in the Uni token that do not rely on volume. So this is just money that is on the table for anyone who wants to come here and deploy liquidity. And you will see usually these newer pools V4, they will likely have some sort of incentives. And I could even come here and sort this out by reward APR to see all of the pools that have incentives here. Currently, these are the only couple of ones, but these things are time sensitive. So this will last from today until February the 5th. So pay attention to that as well, because usually incentives are time sensitive. Now through this dashboard, you can take a look at whatever metric is happening on Uniswap, which is extremely powerful, but likely you want to trim things down and you want to just check out things that are happening on the blockchain you are interested on. So for example, I can come here on Base. I know that Base for a fact is a high performing liquidity pool. Let me just sort out this by pool APR. And if you do that and you sort things out by pool APR because you want the top earning pools, think twice, because you will find likely something like this. I don't know what Russell is. It might be a meme coin or Ray. And these will likely have very, very high pool APR. Sometimes, very often, you will find them triple digits, but they will not be long lasting. So you want more than looking at pool APR, you want something that is reliable. That's why before I mentioned the 30-day volume. This will show you automatically something that was the best performing pool for the past whole month. In crypto, things change really fast. So if a liquidity pool performs for one whole month, likely it will not be a meme coin. And we can see that just here. It's Ethereum, and not just Ethereum, Ethereum paired with the stablecoin, because these are very sought after trades that people do constantly on a daily basis. So in the top 10 of the best performing pools for the past month, you will very often find very solid choices. Ethereum paired with the stablecoin, a stablecoin paired with Bitcoin. This is Coinbase's version of Bitcoin. We also have virtuals paired with ETH. Virtual is more of an altcoin, might be more riskier, but it is a coin nonetheless that has a ton of potential because it's linked to AI, and it's one of the biggest infrastructures for AI on Base blockchain. We have Ethereum paired with Bitcoin, Zora as well. This is a social media one, Soso, USDC, virtuals once again, CBBTC and ETH once again. So you don't have to dig too much. Stick with the ones that are already high performers. And on Base, for example, Base is an Ethereum layer 2, and gas fees on Base are paid with Ethereum. That means Ethereum is a prime token for people to onboard and also to take liquidity out of the ecosystem. and that liquidity usually is onboarded or taken out using some stablecoins. So knowing that, use those liquidity pools that have high TVLs made from blue chip assets, Ethereum paired with stables or Bitcoin paired with stables, maybe Bitcoin paired with Ethereum, and you will have a winning combination for the long run. Now let me show you how you can deposit into one of these pools. The process is just the same, so I'm going to show you using this ETH paired with USDC step by step. So step 1, make sure you have your wallet connected. I'm going to use Rabby. You can use whatever wallet they do support. You can even use the Uniswap wallet. Click connect. Now I'm in. Step 2, select the liquidity pool. Just click on it. And then on the top right corner, you'll have the add liquidity button. Before clicking that, it shows us total APR, statistics, the complete TVL of the pool, the volume, the fees, and very important, pool balances. Why is this very important? Because this shows how much Ethereum and stablecoins are in the pool. This ratio will vary over time and it can cause impermanent loss because of that. But if you are looking to provide liquidity in the long term, forget about impermanent loss, and at some point the fees themselves will break even and allow you to earn money. Sometimes your liquidity pool value will be lower, sometimes it will be higher. It just comes with the game. At some point you will break even. It can take months though, so be aware of that. It's part of the risks of being a liquidity provider. But in my case, I rather have my money working for me in crypto than having it in the bank being constantly devalued by inflation. So for that reason, I'm gonna click here, add liquidity. I could change the pair here. I'm not gonna go and do that. I'm just showing you the possibilities. The fee tier is the one I want. I'm gonna click continue. I'm going to go with a wider range, something like this, wide. So let me zoom out. Let's go with 1 year time frame, and let's set a range that if we're backtesting and optimizing this to see, okay, in the past year, this range would have meant that I would have earned fees non-stop. So I can play along with that, and let's say, okay, so this was a bottom here. Maybe I'm going to cut that out because I'm more bullish right now and I think prices are on the rise. So if that's what you're thinking, just go ahead and adjust that. I'm gonna leave on the upside something like this. Hopefully we will see Ethereum going back to this price range. Once you're happy with it, just come down here. So I have a few cents here of worth of USDC. Now notice that I'm not deploying 50-50 here. I'm deploying roughly double the Ethereum in fiat value than compared with USDC. And that is because my range here determines that, okay? So if I would instead have something on the downside that has a wider range, and on the upside I have something like this, which is a shorter upside, now the ratios do change, and everything above the price range is Ethereum that I need to deposit, and everything below is USDT that I need to deposit. So since I just switched up the ratios here, now I will need to deposit lower amounts of Ethereum than USDC. Let me show you. So actually I think this, yeah, it just automatically updated. Now you see I only need to deposit 3 cents worth of Ethereum versus 7 cents worth of USDC. So you see how the ratio works here. If you go 50-50, something like this, 50% on the downside and 50% on the upside, you see that now this is evened out. And the same thing applies if I go with 20-20, something like this. I'm just making 22, but you get the idea. So 22.5, 22.71. If I go down here, you see now it's virtually 50-50 because of that. The ratios on your ranges are what determines how much of each token you have to deposit, okay? So now I need to review this, and probably you'll have to accept a couple of extra authorization transactions for allowing Uniswap to access funds in your wallet if you never did this before. But once you do that for the first time and you authorize access to the funds in your wallet in USDC and in Ethereum, then you just need to go ahead and create a transaction. You see the network costs here are below 1 cent. That's how cheap Base is in gas fees. So I'm going to click create. I'm going to click sign in, confirm. Transaction completed. Okay, next step is sign in to deploy liquidity. So I'm going to sign in and confirm. Transaction created, and you see here upper right corner created position. Now I will have my positions showing here under pool. You can click view positions at any time, and it will show you this same screen. It shows you the current APR, your position's value, how much it generated in fees. I can come here. If I want, I can remove liquidity, add liquidity, or collect fees at any point in time. Once you select your LP position, it will show you once again the breakdown of the tokens that you deposited, gives you a price chart here, and also the liquidity concentration. So you can see here that there is still a lot of liquidity deposited at around this price range. So there's people who did not withdraw their liquidity, they have it still here waiting for Ethereum price to go back up. That is what these gray blocks on the right side of the image shows. Where is liquidity being concentrated? Now, depending on how much you deposited and also how tight your range can be, you can start to see your fees collecting here. If you deposit large sums of money, or if your range is very tight, these will increase substantially over time. So let me prove to you that you can remove liquidity whenever you want. I just created this position. Now I'm going to click remove, select how much. I could just withdraw 25%, 50, but I'm going to withdraw the whole thing, and I can toggle this on or off. If I keep this on, all of the liquidity that I have here will be swapped to Ethereum. But if I toggle it off, I get my liquidity tokens in both USDC and wrapped Ethereum. So I'm going to go do that, review and confirm. Accept the transaction. So you see the transaction fee here, 0.004 cents of a dollar, literally fractions of cents. I'm going to confirm this. Liquidity removed, tokens are back into my wallet. If you have some fees that you earned here, they will also be automatically sent to your wallet when you do withdraw your liquidity, okay? And that's about it, guys. This is a deeper dive into Uniswap, a breakdown of the whole dashboard and how you can deploy liquidity. Now on screen, you can check out other videos of mine explaining you about DEXs, which ones are the best for beginners, or how you can also use Uniswap to deploy liquidity into a Bitcoin liquidity pool step by step here on the Base network. So guys, I hope you took value from the video. If so, like and subscribe for more. Maybe share this with someone also interested in the topic. I'm going to wrap this one up. Thank you for watching. Take care. Keep exploring crypto, and I'll see you on the next one.